Oh, okay. Okay, cool. Okay, gotcha. Okay, cool, because it's permanently gonna approve. Yeah, it's fine. Oh, but it comes with the job. Oh, no, I didn't have a card. I went to go see one, sister did not need it. And then it shows. Thank you, fine. So I'm just putting in the card.
2 minutes. Oh no, not 2 minutes. Never mind. No, it's 2 minutes. Association, and it's great to be with you again today. Beautiful day outside. I don't know about where you're at, but it's beautiful here, and just so honored to serve you guys as president of the Apartment Owners Association. And what a tremendous group of people you are, so successful with your rental properties. And some of you today have really been in this for decades, and just so much respect for you. We're going to be covering how to do a 1031 exchange, and and how you can avoid the capital gains taxes with that. So before we get into it, our goal is really to help you make and or keep more money than ever before. And we've had a lot of different education things that we've done. We did a member orientation. We did a security deposit crash course, 10 ways to keep renters happy. We had some seminars just recently in Pasadena and Orange County. And we have some more that are going to be coming up here too. With next month, we're going to be in San Jose, Santa Clara, Fremont, Sherman Oaks. So those are coming up next month. So just look at the seminar calendar and reserve those. Those are free for you as a member. And we're just trying to bring you good information. And so hopefully. Oh yeah, and we were in San Diego too. Forgot about it. So yeah, the whole lot that was going on there. And then also, I don't know if you're aware or not, but there's a couple different bills that are on Gavin Newsom's desk. We tried to prevent those bills from ever getting there, but they are there. And now, as a last resort, all we really can do is contact his office for AB 246 and AB 628, those two. So anyway, we have emails that are kind of crafted already, and it's kind of like a click through that you can send that will go to his that will get to him. So go to aoausa.com/PAC, PAC, Political Action Committee. So aoausa.com/PAC. And those different campaigns are there. We also sent out a campaign for LA County. So just politically, there's a lot of stuff going on. And when we all get involved, we have a much better chance at stopping it. So I want to encourage you to just stay engaged with us, open up the emails, or at least go to the website and see those different campaigns that we have running. And anyway, so we're gonna just trying to think, okay, what else am I forgetting here? I think we've got it all for now. Um, this event is sponsored by Real Estate Transition Solutions. They're a real estate investment advisory firm. So they are DST's experts with over 800 exchanges completed, over 27 years that they've been serving rental property owners. They have 4 offices on the West Coast. One in California specifically, they have Orange County and San Francisco, and they're doing about 220 million yearly in replacement properties. And anyway, so we're going to get into this. Our speaker today is a partner and chief exchange strategist at Real Estate Transition Solutions. He's a CPA with extensive expertise in 1031 exchange strategies and tax deferral strategies. He heads Real Estate Transition Solutions team of skilled advisors and analysts, serves as both an advisor and an advocate for owners of highly appreciated real estate. So if you've been around for a little while, your real estate has appreciated significantly. And so he's here to help you. He regularly contributes to educational articles, to highly acclaimed publications like the AOA magazine and Business Insider and other ones. And he just demonstrates his profound knowledge in the field through all of that. So, Austin, man, it's great to have you on today.
Likewise, Jeff, thanks for hosting today.
You got it, man. So tell us about how we can avoid those nasty capital gains tax that'll wipe out like 40% of our profits there.
Wonderful, wonderful. Happy to do so. Jeff, thank you for the opportunity to share with the AOA community. And as Jeff mentioned, my name's Austin Bowlin. I'm a partner here at Real Estate Transition Solutions. Today, we're going to be discussing broadly 1031 exchanges, specifically the rules and the mechanics associated with 1031 exchanges, the timeline that exchanges have to adhere to, which is quite defined by the IRS, and some of the replacement property options that are available by way of the 1031 exchange. Now, one of the replacement property options that our firm works extensively with, and Jeff made reference to, is what's referred to as a Delaware Statutory Trust, or DSTs as they're more commonly known. DSTs are unique in that they are both eligible for 1031 exchange purposes as like-kind property. That's a term you'll hear me circle back on and define in more detail, but also treated as securities per the SEC, the Securities and Exchange Commission. And as what's referred to as a Regulation D security, there is a requirement that in order to invest in DSTs, one must be considered an accredited investor. Now, typically an investor is accredited by virtue of having a net worth in excess of $1 million, not including the value of your primary residence, or alternatively, by having annual income in excess of $200,000 as an individual, $300,000 if you're married filing jointly, or by holding a number of professional licenses or certifications. What you see here is an overview of what we're going to be discussing. We'll give a little bit of background on our firm and the work that we do, and then we'll dive right into the topic at hand, which is 1031 exchanges. We'll talk through the rules and requirements associated with exchanges, how one can plan for a 1031 exchange to make it as seamless of a process as possible, and increase the likelihood of acquiring replacement property that serves to address your objectives. We'll talk through various ownership structures in which you can exchange in or out of, and then also walk through an illustrative case study. And as always, we'll share some additional educational resources and make sure to save time for some Q&A at the end. Jeff gave a great introduction of our firm, Real Estate Transition Solutions, or RETS as we're commonly known. In a nutshell, we're a real estate advisory firm that really focuses on serving property owners that are navigating transitions, and we'll call it the third and the fourth quarter of property ownership. All of our work is really built on the premise rather, that owning real estate is dynamic. Physical properties change. They have maintenance requirements, capital improvements needed. Market conditions change around properties. The regulatory environment changes often faster than any of us would like it to. And on top of all of that, owners' objectives change as they go through the decades and the chapters of life. It's very common for a property owner who's maybe in their 30s or 40s, still receiving earned income from their job, from their primary occupation, to be more focused on appreciation and less sensitive, to call it, to cash flow. But then when you enter more traditional retirement years, maybe it's the opposite of that. Maybe you want to have some appreciation, but you want to also be earning stable, predictable income. Or perhaps you've built a real estate portfolio of 3, 4, 5, whatever it may be, single family rentals or multifamily properties, and you're looking at your portfolio and saying, this has been great. This is how I built a healthy portion of my net worth. However, I'm concentrated in a single property type, in a single geographic location. And that concentration risk should be considered as you go into these more traditional retirement years. Estate planning, another major consideration. Real estate has the opportunity to benefit from a step up in basis, outright elimination of your accrued and deferred tax liability when you or your spouse pass away. But it's not the easiest asset to transition to your beneficiaries without forcing them into a co-management situation. And that can create, unfortunately, some tension in families. We see that play out all the time. So how do you stage your real estate portfolio to take advantage of the tax deferral and the eventual tax elimination, but then stage for a seamless transition to beneficiaries? These are the type considerations that we work through with our clients. We help to analyze the properties they own, discuss and determine their objectives, both now and in the future. And if there's a gap between the two, then develop a intentional and cohesive transition strategy. Because fortunately, given we're talking about investment real estate, you have the ability to reposition your investment real estate using 1031 exchanges on a tax-deferred basis. We have extensive experience working with 1031 exchanges. This information you see here is as of the end of Q2 2025. At this point, we've completed almost 1,000 1031 exchanges with our clients, and we really focus on passive replacement property options, the DST being the primary ownership structure that we're utilizing there, but also the tenant in common and 721 UPREIT properties as well. We have just over $1.5 billion of DST real estate under advisement as of right now. I use the term advisement because we don't physically manage the properties themselves. That's the responsibility of entities that you'll hear referred to as DST sponsors. We've completed nearly 2,000 individual investments into DSTs among close to 300 individual DST properties themselves. The firm was founded just over 20 years ago by my father, Roger Bowlin. Here you see a snapshot, mugshots, if you will, of a few of the key individuals on our team. But as Jeff mentioned, we have offices down the West Coast. We're headquartered in Seattle. We have an office in Portland, San Francisco, and Orange County as well. And we work with property owners all over the United States, a healthy portion of which are California residents or California property owners. So with that background on our firm, let's dive into 1031 exchanges. What is a 1031 exchange? A 1031 exchange is a transaction that is made allowable per a section of the tax code where the name is derived from, Section 1031. And many consider it to be one of, if not the most advantageous sections of the tax code, because what it enables is a individual or an entity that owns investment real estate, provided they follow the necessary steps, to defer all of the tax that would otherwise be due upon a sale into what's called replacement property. So when you're selling a property and performing an exchange, the property or properties that you're selling are referred to as the relinquished property, and the properties that you purchase are called the replacement property. And this could be in the singular or plural. It very well can be multiple properties, and that's very commonly done by our clients. So the tax that would be typically due upon the sale of a property is not just federal capital gain tax at 20%. It's also depreciation recapture tax at a flat rate of 25%. That's applied to the accumulated depreciation, the sum total of depreciation that you've taken over the period of ownership. It's net investment income tax, which is a 3.8% federal tax applicable both to the appreciation and the accumulated depreciation. And for most of you who are joining us today, it's California state income tax, which can be as high as 13.3%. So all told, you can be looking at the highest aggregate tax rate applied to the sale being as high as 42.1%. When selling property in California, or if you are a California resident. That's a massive haircut to take upon selling a property, unless a 1031 exchange is performed, in which case you get to keep all those funds working for you. There are a few parameters that we'll talk about right now, just right off the top. One, the property does need to be investment property. Two is the property that you're selling and the property that you're purchasing do need to be located within the United States. It does have to be domestic property. There's a myriad of objectives in which 1031 exchanges can serve to address. Some of the common motivations that we see for property owners who are selling a property and acquiring replacement property could be time management. They may want to acquire property that's going to be less intensive from a management standpoint. Could be changing the return profile, perhaps wanting higher cash flow or wanting to unlock more tax sheltering. Could be diversification. Could be a liquidity strategy that they want built in so that they can get dollars at their timing or on a tax-free basis from their replacement property. Could be that they see opportunity in different markets or with different property types that they want to take advantage of. We hear a lot of California property owners who are saying, just don't like the regulatory environment. I don't like the demographic trends that we're seeing in California right now, and I would prefer to have this healthy portion of my net worth invested in states, in markets where we see a more balanced regulatory environment and more economic opportunity associated with it. On this slide, you see a snapshot of a few of the objectives that are commonly discussed and integrated into the exchange strategies that we work with our clients to develop. Now, there's a term that you will almost always hear associated with 1031 exchanges, and that's like kind. This is coming from Section 1031, where it says the relinquished property and replacement property need to be like kind with one another. And a common misconception is that that means they have to be the same property type. That's not the case. The IRS is actually looking not at the property type in defining like kind, but instead the intent as to why that property is owned. Importantly, all property held for business or investment purposes is considered like kind with one another, regardless of the property type. So there's really just two categories that most individuals need to be aware of as it relates to intent. There's personal use property. This would include one's primary residence or if they have a family vacation home. And then everything else, for the most part, falls in this category of held for business or investment purposes. Could be a vacation rental, could be an apartment building, could be a single family rental, could be agricultural land or hospitality, whatever it might be, you name the property type. If it's held for business or investment purposes, they're considered like kind with one another. Now, there's a timeline that is very rigid for 1031 exchanges. And it's critical that anyone considering an exchange be familiar with this timeline when going into it. First and foremost, when you are selling your property, you're free to sell it just how you normally would. You can sell it yourself, you can engage a broker, you list the property, you start fielding offers, eventually you accept an offer, and a purchase and sale agreement is signed. When a purchase and sale agreement is signed, escrow is typically opened on behalf of the seller. That's who will hold on to earnest money throughout the close timeline. And that's when you should set your 1031 exchange up with what's called a qualified intermediary. The qualified intermediary is the entity that will hold on to the funds on your behalf while the exchange is being performed, so that you do not take what's referred to as constructive receipt, i.e. possession of the funds. That qualified intermediary holds the funds while you're evaluating replacement property options. And then once you have selected your property that you plan to purchase, they release those funds to the seller of that property, and then you're able to close on the acquisition of your replacement property. So that exchange has to be set up with the qualified intermediary pre-closing. The sale occurs, the funds move to the qualified intermediary, and now you have 45 days to identify your replacement property. After the 45th day, you cannot add any new properties to that identification. So this is really the go time during these 45 days. It's very common in the exchanges that we work on to not use that whole period of time. We'll often complete the exchange within a week or two post-sale, which provides continuity of income, which is often very helpful and desirable for property owners. But you have up to 45 days to identify your property, and then an additional 135 days, making for 180 days post-close to actually complete the purchase of your replacement property. A couple other rules to keep in mind. I mentioned setting up the 1031 exchange pre-closing. I mentioned the fact that both the relinquished property and replacement property must be like kind with one another. Another rule to take into account is the fact that the taxpayer on title upon the sale of the property needs to be the taxpayer that acquires the replacement property. Now, if you own a property in a revocable living trust or a single member LLC, you are the taxpayer. Odds are you're just using your own social security number as the tax ID for those two different entities. So it would be the same as if you held title in your own name. If you own it in a regarded entity that has a tax ID associated with it, that's the entity that needs to purchase the replacement property. That begs the question of, well, what if you co-own a property? What if you own a property with a sibling or a business partner and you want to go separate directions? If that's your situation, reach out to us. We can talk about legal entity restructuring and some of the strategies available to allow you to go separate directions if that's a goal of yours. Next requirement, in order to have full tax deferral, the replacement property must be equal or greater property value to that which you sold. And that's not based off your gross sales price. You get to deduct your closing costs, but you must purchase that much property value in order to have full tax deferral. And you must utilize all the equity resulting from the sale to purchase replacement property. Lastly, as it relates to identification, unfortunately, you cannot identify an unlimited amount of property. There's 3 different approaches that are allowable per the IRS for identification purposes. You can either identify up to 3 properties, regardless of the value of the property, or you can use the 200% approach, which allows you to identify up to 2 times the sales price of the property you sold, regardless of the number of properties that make up that identification. Or you can use the 95% approach, which allows you to identify an unlimited number of properties for an unlimited aggregate value, but you must close on 95% of the value in which you've identified in order for it to be a valid identification. When we consider 1031 exchange planning and staging, in our mind, the process and with our approach, the process starts much earlier than the actual IRS mandated exchange timeline. It really starts with, first and foremost, calculating and understanding the tax liability that would otherwise be due upon the sale of the property. This is table stakes, if you will, for knowing what are the consequences if an exchange were not performed. That's a key input. Next, it's focusing on making sure that a property owner has a strong grasp for the rules, what is and what is not allowable within a 1031 exchange. The last thing we want is for someone to have sold a property, funded an exchange, thinking that they can do something that's not allowable. Then we really shift the focus over to the property owner and start diving into objectives. Where does this property fit in one's overall financial picture? What are they seeking to accomplish through the exchange? That's a dedicated conversation or conversations in and of itself, hitting on about 25, 30 different topics that we work through. And from there, and you'll note this, all 4 of these steps that you see on this slide are all before the property is actually sold. Then we're going to go out and get the lay of the land as it relates to replacement property options that can address those objectives and give you visibility into what an exchange could look like, will look like when the time to sell actually occurs. Now you go through the sales process. You engage your broker, you list your property, you field offers, you accept an offer, and then you're moving toward a close date. Once you have an accepted offer, you set that exchange up. Once the sale closes, the exchange is funded. And now in this period of time, we're sharing specific properties that are actual candidates for your exchange. Selections are made, funds are reinvested into the replacement property, and your exchange is closed. If you haven't already done so, this is the time in which you want to notify your tax preparer that you performed a 1031 exchange. And when they see that a property was sold for tax reporting purposes, they know to defer all of that tax that would otherwise be due. Now, when we talk about replacement property options, there are 3 broad categories of, we'll call it ownership structures that are eligible for 1031 exchange purposes. Starting on the right-hand side of the slide, fee simple property is the widest tent here. That's likely how most of you own your properties today. Direct ownership, outright control of the property, all the management responsibility and decision-making authority. The Delaware statutory trust and the tenant in common ownership structures are fractional ownership structures. This is where you can exchange into owning a portion, a fractional interest of larger institutional quality properties. Typically passive investments. There's distinctions between the two, which we'll save for a later date, comparing and contrasting those two. But this is where you can start to diversify among multiple different properties. You can have a portfolio of DSTs or tenant in commons or a combination of, or even integrate a fee simple property into the equation. And it can really be curated and designed to address your unique objectives. Within the DSTs, each individual DST is almost always going to be property type specific. A DST may own a single property within it, or it could own a portfolio of property. And importantly, you as an exchanger can easily invest in multiple different DSTs, but they are almost always going to be property type specific, which enables you and empowers you as the exchanger to decide if you want to invest exclusively in multifamily property or exclusively in industrial or a blend between multiple different property types. You can do so. You're not forced into any allocation that's preset and determined for you. And different property types have different opportunities, different considerations, different return profiles, and can be very effective in addressing exchangers' objectives. DSTs have become a very popular replacement property option for a number of key reasons. One, it's an ownership structure that allows you to invest in different markets and different property types where you don't have to have actual experience having owned those property types, because you get to leverage the management expertise and the due diligence and the underwriting process of these large institutional real estate firms. You don't have to have boots on the ground relationships and vendor relationships in Atlanta or Nashville or Dallas, Texas, markets you might want to consider investing in. It also allows you to diversify among multiple different property types and have a very seamless ownership structure for transitioning to an eventual surviving spouse or to beneficiaries. There's a number of benefits and attributes that are attractive within DSTs, and I'm not going to walk through all of these today, but there's a good reason why we're seeing, call it plus or minus about $10 billion of DST real estate being acquired on an annual basis. And it is a increasingly popular replacement property option, especially for owners who find themselves in those more traditional retirement years. When we talk about investment minimums, it's a common question. They're actually fairly low. So you do have to be an accredited investor, typically net worth over $1 million. But the minimum investment amount for a DST is often only $100,000. A few are $250,000. But what that means is even if you're selling a property where post-closing costs, post-loan payoff, you're looking at, say, $300,000-$400,000 of exchange proceeds, you can still diversify among multiple different DSTs. For those of you who have debt to replace in an exchange in order to have full tax deferral, most DST properties have some leverage associated with them. Not all, but many do. And that debt's almost always, the debt will always be non-recourse, that does not require any underwriting or qualification from an investor standpoint. When we look at 1031 exchange, and again, the motivations behind why one would consider exchanging, very commonly it is because the property that they own today no longer fits with their objectives. And they want to invest in property that is a better reflection of those objectives and has more opportunity associated with it. It could be because of a new property type, a new market. It could be wanting to have exposure to commercial property, enhance the cash flow. Cash flow enhancement is something that we see regularly for those that own single-family rental properties, because it's not uncommon to see a property produce 2.5%, maybe 3% cash flow when we look at the net income expressed as a percentage of equity in that property. Whereas most DST properties, for instance, commonly we're looking at, call it 4.5% to 6% cash flow. So an immediate opportunity to increase one's income right out of the gates. Additionally, when we look at the rate of change that we've experienced from a regulatory standpoint, from an economic growth and demographic trend standpoint, in the West Coast specifically, the growth in our country is frankly happening in different markets. It's happening in the South, in the Sun Belt, in the Mid-Atlantic. And for those who want to go into a more balanced regulatory environment where employers are relocating, expanding their presence, whatever it might be, the Delaware Statutory Trust ownership structure is a great vehicle to do so, with, again, not having to have that direct experience or boots on the ground relationships yourself in those respective markets. This slide just shows a quick demonstration of, if someone were selling, let's say, a single family rental out of Southern California, it's very achievable to design a broadly diversified portfolio with exposure in some of those markets that many economists feel have their best years ahead of them. Now, whenever looking at replacement property options, whether it's a fee simple property or Delaware Statutory Trust or tenant in common properties, due diligence is critical. And this is something in which our firm has invested heavily in over the past 10 years or so, with a 5-person in-house due diligence team that spends all of their time evaluating sponsors as operators, which is about a 6-month process whenever we're considering a new sponsor to work with. And then should a sponsor be approved, should the sponsor make it through sponsor level due diligence, then we will begin underwriting each and every property that they acquire to determine if those individual properties themselves meet our criteria for recommending to clients whom we are working with. I would say on average, about 60% of the properties put forward by approved sponsors make it through that property level due diligence process. The property level due diligence process is where we start to see some major forks in the road depending on the property type and what we care about, what we consider, and what we're evaluating. And we're going to evaluate multifamily properties far differently than we will industrial. And if you're interested in learning more about the due diligence process, I would encourage you to join us for an overview of our due diligence process by way of our due diligence webinar. Regardless of whether you're leveraging our firm's due diligence process, considering working with a different firm, or performing your own due diligence, it is critical to have a robust and established process so you have the highest likelihood of achieving the desired outcome. So with all that quick illustrative case study, here we have a husband and wife, John and Pamela, whom we worked with on an exchange, Southern California, latter part of 2024. They owned a 10-unit apartment building in San Diego, had owned it for 30 plus years at that point, or just approaching 30 years rather. A property was originally purchased for $850,000. They were tired of managing the property. They wanted to spend time traveling with their grandchildren, pursuing hobbies, and it represented a meaningful portion of their net worth. And so they had decided that they wanted to sell the property, but when they met with their tax preparer, they became aware of the fact that they were going to pay nearly $750,000 of taxes upon the sale, based off of a value of 3.2 million. So the property had appreciated significantly. It was fully depreciated at this point, and that tax liability was substantial. At that point, they reached out to us. We began discussing 1031 exchanges, educating them on the process. We shared about Delaware statutory trusts as a way in which they can have a diversified portfolio. They can defer all of their tax. They can have stable, predictable income, moderate appreciation. And we landed on a portfolio design that you see here on this slide. Ultimately, they ended up having about a 35% increase in the income that they were earning by having exchanged into DSTs, while simultaneously, and this is critical for California residents, decreasing their taxable income by way of depreciation that was generated, all the while being passive, investing in high quality institutional properties, and having substantial diversification. If you are interested in discussing replacement property options, you can of course look at all the properties listed on the internet, through Zillow, LoopNet, CoStar, Seba, etc. Or you can reach out to us and have a conversation with an exchange advisor who will walk you through this process, who will make sure that you know all the options you have available to you and can really tailor recommendations based off of your objectives. For those of you who would like to see new DST properties or illustrative closed properties, you can do so by visiting our AOA hub page. This is a sub web page on our website that is really tailored specifically to AOA members, so it's only applicable to California property owners. But within that page, you'll see a marketplace, and that marketplace will give you a feel for the size and quality and caliber of DST properties that have successfully made it through our firm's due diligence process. As far as additional educational resources go, the best opportunity, if you have any questions or would like to discuss the specifics of your situation, is to reach out and schedule a complimentary consultation with one of the advisors on our team. We are always happy to talk to members of the AOA community. You can schedule by visiting that AOA hub page. You can call the number you see at the bottom of this slide here, or you can visit our website and actually schedule directly onto the calendar of any of our exchange advisors on our team. For those that would like to learn more about specifically the DST replacement property structure, our guide to investing in DSTs is a great starting point. This is a complimentary download. It's about a 28-page guide. It'll give you a good feel for the history and the mechanics and some of the strategies available using DST replacement property. And then lastly, webinars are a near weekly occurrence here at RETS. We make all of our webinars available on demand as well. So after we host a live webinar presentation, you can always view the webinars on our website and just spin through the topics. If there's any that are of particular interest to you, you can watch them at a time that's convenient for you. Here are two of the webinars available in our on-demand library, but that's another great resource to learn more about these topics. Well, Jeff, that's all I have on my end. Happy to pivot over to any questions that might have come in from
Yes,
attended
awesome.
today.
Awesome. Yeah, I got some questions here. And for those of you that aren't aware how it works, if you're watching from AOAUSA.com, there's a little blue help button where you can get questions into there, and they'll funnel them over to me. And if you're on YouTube, you can just put your question in and I'll get that. And yeah, so first question is, so like if I were to die,
Mhm.
how liquid would this be for my heirs? Like,
But
let's say I'm in the middle of a, I'm in one. At that point, what would the process look like, and how liquid would that be?
yep, that's a great question. So with the traditional DST structure, the average hold period for the property is typically 5 to 7 years. That's what we always present it as. In practice, it's actually a little bit shorter than that, but just to level set expectations, 5 to 7 years is the range that we always present. It can technically be held as long as 10 years. And often what happens is you're best served by holding the investment until ultimately the underlying property itself is sold, at
Mhm.
which time there's a liquidity event made available for all the investors. Those who would like to exchange again can do so, whether that's into a new DST or back into the local market, acquiring a fee simple property. You could always choose to recognize your tax liability at that point. And for those who passed away and a step up in basis was realized, then odds are a surviving spouse or beneficiaries are just going to take the sales proceeds because there's little to no tax consequences. If you want to sell your ownership early, say, Jeff, you were to pass away and your surviving spouse, your wife was to say, I don't have a tax liability any longer, and I'd be interested in selling my ownership. There is a mechanism to do so. That's something in which we can help to facilitate, and we would make your ownership available to all the exchangers whom we're working with now and in the future. You have to agree upon pricing with them, and technically it would be a private party transaction. But that is an option available. There's also a category of DSTs where after a shorter hold period, a 2 year hold period, the DST property is absorbed by a real estate investment trust and your ownership converts into effectively shares of that REIT.
Mhm.
Once you're up in that REIT, there's typically a 1 year lockup period. So now we're 3 years post sale and exchange, at which time those shares are liquid. So that's often a common, we'll call it last step in the exchange cycle, where when someone gets up into those mid 80s, early 80s, depends on the individual, they might utilize the 721 uprate structure so that then they have a liquid investment for beneficiaries so they could just sell the shares immediately upon realizing that step up.
Hmm. Great. And yeah, and then let's say you do take it to the next, you complete the cycle.
Mhm.
What are the costs going in? What percentage are we looking at when they go into the next exchange?
It's pretty lean. I mean, the only out-of-pocket cost that you're going to incur is the cost of utilizing the qualified intermediary. So typically, depending on the qualified intermediary and the number of replacement properties you acquire, that's anywhere from $1,000 to $2,500. But there are structuring costs built into the DST itself, but all of the financial projections are based off of a full investment amount. So when we talk about a DST that's projected to distribute 4.5 or 5 or 5.5 or 6% first year cash flow, that's based off of the full investment amount exchanged into that property.
Right. So let's say it's $10 million property.
Mhm.
When it's like it was a $10 million investment that they had into the 1031 exchange. So when it goes into the next one, how much of that 10 million is because it's like you're just like you would pay if you're going to sell it, you would pay a
Mhm.
commission and and those different fees. So how much of that 10 million would be going into the next DST?
So if 10 million was originally invested, let's say just for simplicity purposes, it went into a single DST, which would
Yeah.
probably be the case. But if that were to occur, then it's going to depend on how much appreciation that property's realized because the appreciation legally has to go back to the investors. So let's say, just for the sake of argument, that $10 million investment appreciated up to $13 million, 30% appreciation over a 5 to 7 year hold period, which is very much achievable. At that point, when the property's sold, there's still going to be standard transaction costs for the actual
Right. Yeah.
sale of the underlying real estate. Your primary cost there is going to be brokerage commissions, but The brokerage commissions are often coming out of the sponsor's disposition fee. And it is, as a percentage of the total property value, much lower when we're dealing with institutional properties. Because commonly those brokerage commissions are fixed. They're not a percentage, but instead maybe it'll be 250,000 on, let's say, a 80 or $100 million property. From there, then the sponsor does have an opportunity to take a disposition fee. That's commonly 2.5% to 3% of property value. And then there may be title and escrow and the like. Everything else is distributed pro rata to the investors.
Great. And then, you're cash flowing here. So how are taxes reported?
So same as anyone's property today, the rental income after having factored in all of the operating expenses at the property level, so the actual net cash flow received, less depreciation. So you do have continuation of your tax sheltering, and in many situations, more depreciation available. And that's something in which, if you're curious to discuss, we can dive deeper into. But the taxable income is taxed at ordinary income tax rates. And as if you're a California resident, then that's going to be subject to California state income tax, because California taxes all income earned both in and outside of California.
And then I see one final question here. If you have a question, now it's time to put it in because this looks like the last one. What percentage of people enter into another DST after they complete that first cycle?
It's a good question. We do have a few clients that exchange into DSTs going in knowing that when that property eventually sells, they're planning on acquiring another fee simple property. And that's probably the most common scenario where we'll see a exchanger concentrate in a single DST as opposed to diversifying. Because when you diversify, inevitably you're going to have different sale dates of those respective properties. Otherwise, the other scenario where people would not continue to exchange is that scenario you made reference to with your first question, when someone passes away. I mean, if you don't have a tax liability due upon the sale, you should likely just take the sales proceeds. When we talk about the population that has yet to realize a step up in basis and is not going into the DST planning on acquiring a fee simple property down the road, so they're really just using the DST as kind of a placeholder for 5 to 7 years, the vast majority will ultimately exchange into another DST when that eventual sale occurs.
Great. Well, hey, I appreciate your time. And
Always
it's
a
always
pleasure.
great to have you on. You're always such a peaceful person,
Thank you.
very calm and everything. So yeah, I just really appreciate you.
You bet. Jeff, always a pleasure to see you. Thank you for the opportunity to share with the AOA community.
Awesome. Thank you.
Thank you.
It feels like
Bye-bye.
the weekend. It's not the weekend yet, but
Oh, it's right around the corner, though.
all right. Take
All right,
care.
take care, Jeff. Bye-bye.
Bye.